Randy, how about you go ahead and get us started with an introduction? Kevin is, I think, logging on as we speak.
Okay, our apologies. Good afternoon, everyone. I'm Randy Price. He is Matt Price. We are the Price Group, and we apologize for running a little bit tardy due to some difficulties, but we are making up ground, and I think you will find the guest and the topic that we have today are exceptional. Kevin Simpson is the founder of a money management firm who we absolutely like a whole lot, based in Naples, Florida. Capital Wealth Planning is knocking on the door of about $10 billion. Kevin is an author, a nice guy, and one of the industry's expert on covered call option writing. And if you have an interest in that, Kevin's book is truly A+ from a technical and a historical perspective. But anyway, a nice guy, a very competent CEO, and a man who really cares about his clients. Capital Wealth Planning, Kevin Simpson.
And Randy, how about you give us a little maybe background on what the strategy is and how we've used it for the last 10 years?
Why not? During retirement, income is the primary focus, right? Cash flow. You can't spend appreciation, so cash flow is the name of the game. Those of you that are familiar with the Price Group, and the majority of you are clients, but we have some guests as well, know that we have an affinity for dividend stocks. Capital Wealth Planning puts an additional extra twist on that, in that they use a income enhancement strategy, which also helps decrease risk, called covered call option writing. And when many of our clients hear the word option, they think risk, but covered calls are one of the few things that are allowed inside an IRA, and it truly is again, will add income and reduce volatility. And so they've become experts on writing covered calls, not on the whole portfolio, although they can, but tactically on stocks that have reached their sell target. And as a result, they've had excellent historical results from a standpoint of not only total return, income historically in the 4 to 6% range, and also on a risk level, historically speaking, a risk level about 80% of the market as a whole. So they really fit have all the bells and whistles that our clients are looking for. That is income, extra income with reduced risk, stocks that I comfortable with, and it's been a good partnership here the last 8 years.
This phone needs to be fixed.
Kevin, nice to see you, sir. How are you?
Sorry.
We appreciate you being with us. I gave the group a little bit of a background of your book, a background of how successful your firm has been, and that if they ever want to come to Naples, Florida, all they got to do is knock on the door and come in for a cup of coffee. But
We're always here.
There you go. But anyway, you've been a big help to us. You've been a fabulous partner over the years since I guess we met about 10 years ago or so at our prior firm. And your firm obviously has been very successful. And we appreciate you taking some time and sharing a little bit of the philosophy and what clients may want to know given this point in time with some of the recent market volatility, sir. So turn it over to you. It's all yours.
So you're saying there was some volatility this week? Is that what we're talking about? Boy, I think it was just an incredible 3 sessions. We started to see some sell-off last week, and then Friday with the labor numbers, the unemployment report, and the actual unemployment number ticking up to a few notches, scared the heck out of the market on Friday. But that had very little to what happened yesterday. You know, we talk about it being a growth scare, like we think, oh, the recession's a possibility. The Fed has waited too long to cut rates. I saw people on CNBC like hysterical yesterday. The Fed needs to come out and do an emergency rate cut. And what happened yesterday, although there's no guarantee that we won't have a recession, don't allow my optimism to be confused with naivete. the growth is slowing, so it's very possible that there could be economic hard landings. The soft landing is certainly no guarantee, but the idea behind what the Fed's done and how well things have played out so far is dependent upon data, economic data. Inflation has come down. It's not at 2% yet. The unemployment market is a little bit more stable, as we learned on Friday. What happened over the weekend and into yesterday was just a combination of a lot of very, very heavy institutional trades breaking the wrong way. There was a very, very serious rumor believed that Wall Street believed that the tensions in the Middle East were going to heat up. That played a big part of it over the weekend. There was a short VIX trade that's been working for the past few years that everybody's piled in and leveraged. And you saw the VIX spike yesterday. And then finally, there's the yen carry trade. And I don't know if anyone's ever explained that really well on TV, but there's a simple construct there. And it's been a couple of years, like a really easy trade. But what happened is an institution would short Japanese yen or Japanese bonds. So the interest rate there was artificially, has been for a long time, artificially low. So you'd pay maybe 1.5% carry trade to short Japanese debt. With that 1.5% expense, you could take that and you could buy a US Treasury and get 5%, and you keep the 3.5% spread. And the trade can work, and it has for institutions for a couple of years, as long as there's not a disparity in the dollar versus the yen. As long as Japan doesn't come out and make a surprise rate hike. Well, they did. And there was a 10% divergence between the Japanese yen and the US dollar. And these trades are leveraged in a huge way. Now, I gave you the example of buying a US bond, getting that 3.5% almost risk-free spread. Well, most people don't do it that conservatively. They're borrowing, paying the 1.5% carry cost, and they're buying the Magnificent Seven. So when you see the price of NVIDIA go down 30%, I know that's impossible to believe since it doubles every day, but it goes from 130 to 30. And you're not talking about 10% leverage, like 90% equity. It's almost the opposite. Like you're borrowing 90% and you have 10% money at stake. Think of 1929, although it's not quite that bad because you're dealing with debt, government insured debt. So you get these huge margins. So someone, and we may never find out who it was, I heard a rumor that it could have been SoftBank, but that's no substantiation there. But some big hedge funds got destroyed and they had to close out and they got margin calls. And that's really what happened yesterday to exacerbate everything else that's happening. So is growth slowing? Sure. Is volatility increasing heading into a presidential election? Absolutely. Is the Fed going to cut rates? They sure are. They basically told us that on Wednesday and everyone was fine. Here we are, 3-4 sessions later, and at least yesterday, the world was coming to an end. Only it really wasn't, because the fundamentals hadn't changed. We got good ISM numbers yesterday, even better than expected. The jobs report had over 100,000 job creations. That's not too shabby. Now we're going to get more information over the next month before the September Fed meeting that will talk about inflation. So we'll get 3 inflation reports. We'll still get 1 more jobs report for September. But all things being equal, even including Friday and yesterday and what happened. Fortunately, it was a weekend. The Fed's going to cut rates in September, probably a 1/4 point, maybe 50, although I don't think they need to. They'll cut rates again at least 1 more time, maybe more. The panic number today was, well, they've got to cut 150 basis points before January. And I don't know that that's really true. The balancing act, the really challenging thing for the Fed is, yeah, sure, it sounds great to lower rates and it's good for the stock market, but we don't want inflation to go back up. And that's the thing that they don't want, which is why they've kept it higher for longer. So here we look at the year and we're basically trading at the levels that we were in the spring. Not much has happened. Could the stock market go down another 5% from here? Yeah, absolutely. Randy, you and I have been in this business for way too long. I mean, in the old days, we would see 5-10% pullbacks more than once a year. Like it was just fairly routine. It felt to me like every other year we'd see a 20% pullback. It wasn't anything to freak out about, but we didn't have these things. So we weren't constantly checking it every 5 seconds, and it allowed for a little bit more smooth market. The 87 crash was a result of some computer intervention for sure. Definitely the 2 flash crashes we saw. 08, that was a credit crisis. We're not there. I saw somebody in the Wall Street Journal today comparing yesterday to 2008, which is like pretty poor journalism. It's not 2020 because thank God we don't have a pandemic. So seeing the markets have 5 or 10% air pockets is very normal. Usually you don't see it all in one day like that. Usually you don't see the VIX spike the way it did. But for most retail investors, for us as long-term portfolio managers, rather than panicking yesterday, we took some of the cash that we've had on the sidelines. We bought more Apple. Even though Warren Buffett sold half of his, he sold it up at 230. We came in yesterday, we're buying it in the very low 200s. And oh, by the way, it's still his largest position. And 20% of his portfolio is in Apple. So it's not like he abandoned the Apple trade. We also bought American Express yesterday because we look at this economy as almost like a K shape where there's two really distinct differences between the high-end consumer and the lower-end consumer. Inflation and higher interest rates obviously affect those who can least be affected by it the most. And the higher-end consumer has gotten through it with pretty good spending habits. You look at retail sales, consumer confidence, luxury goods. Are they cutting back in certain places? Yes, but it's not rolling over. And if we go into an interest rate declining phase where the Fed's going to be cutting interest rates, not just for September and December, but throughout all of 2025 and presumably into 2026, you can see a very, very smooth landing strip for this soft landing. Now, anything can switch that to a hard landing in a second, which is why it's called a hard landing. The unemployment number shooting up, definitely tensions overseas, and growth going negative, contraction in a contraction phase, because that's what a recession is. It used to be in the old days, it was just 2 quarters of contraction. Now there's the Bureau of Economic Research that tells us if we were in a recession long after it's over. But the idea of a recession is a head scratcher because in the second quarter we had 2.8% GDP, and maybe that was a little high for seasonality. But the Atlanta Fed is saying, you know what, for Q3, pardon me, we're expecting another 2% GDP. It's not awesome, but it's still growing. It's still growth, and growth is still growth. So I think that the volatility should continue throughout the rest of this year. I'm not expecting smooth sailing. We're not certain that the unwind of the yen carry trades are over. There could certainly be other institutions that are in the same pickle, and they're just treading water, trying to buy themselves a little time. We don't know how earnings are going to be for next quarter. We know they were pretty good this quarter. We still have NVIDIA's earnings, and that's the biggest, probably the biggest stock in terms of just people following it. And it has so much to do with the AI trade. We also have the prospects of inflation coming back, which we definitely don't want to see. I doubt that we would expect it to be linear, but you don't want to see a big spike in there. Gas prices are at a 10-year low. That's pretty good. Mortgage rates are at levels that we haven't seen in a year and a half. That's good. And we know they're only going to go lower. So from the standpoint of the economy, is it horrible? No. Is it a recessionary? Are we on the brink of a recession? No. The 2 years that we've seen the inverted yield curve is usually a precursor for a recession, but you can play with data. Maybe we get a recession in 2026 and you say, well, we were 2 years inverted. It took 2 years for the recession to come. It's just a way of proving that you were right if you're an economist, because it so rarely happens. But that the economist's right, not that we have a recession. Recessions happen. Economists are very rarely right. So that's why we don't have them on staff, because we might be tempted to listen to them. So I watch thank you for laughing. So I watch all of this stuff with kind of separating the emotion from it and just kind of thinking it all comes down to math. And that's all it really is. Economics are math-based mostly. Stock investing is really way more math-based because it's two things that determine a stock's price. How much money does the company earn and what multiple do we attach to it? So you could say, well, in the S&P 500, we have a 21 multiple. We're kind of stretched right now, and I don't disagree with that. But a lot of the big tech companies are trading at higher multiples. And right now, we're already looking at 2025 earnings to kind of see how can it get to 6,000? Well, if 2025 earnings are really good, it can get to 6,000. And guess what? It will get to 6,000. It could go to 2,000, and it might take 10 years to get to 6,000. But it will get there because of multiple expansion and companies earning more money. I was taught that it's really easy to invest. You find good companies, and as long as their earnings are increasing, as long as they make more money next year than they did this year, eventually their share prices will follow suit and you'll get good total return. with our strategy, with all the great things that we do in partnership with Randy and Matt, it's not just about earnings growth, but it's about dividend growth. So the real, like the story to our success is finding companies that are increasing their dividends because they're increasing their earnings. And now we've got two things going for us in a big way, which is the true like secret to wealth creation, the power of compounding, dollar cost averaging. We're getting about a 2 to 3% cumulative dividend yield, which is good. But the under the hood, every single year, every year, we want that 2 to 3% to be increasing at a 10% clip. Now that's a high bar. We don't hit that bar, but that's our goal. That's what we're shooting for. And for the past 12 years, our dividends have increased on average per year at 9 and change. So almost hitting that 10% number. And if we're walking into the door knowing that with pretty good confidence that our expectation is, no guarantees, but our expectation is we're going to get a 9% raise, that's a heck of an inflationary hedge. Whether inflation's at 9% or it goes back to the Fed's 2% level, we want to be able to have an appreciating income stream. And if we're not taking the distribution, then we're just old-fashioned compounding, which is important, because really that's the secret to investing. If you go back to 1926, and that's really where the Dow Jones and the S&P numbers are very accurate, you get an annualized stock performance of 10.2%. And I'm quoting the S&P 500. So for almost 100 years, 10.2%, which is great. That's why you work with the price group. That's why they manage the risk. Let's get double-digit returns. Some years we're up 30 and we think we're geniuses. Some years we're down 30 and we want to jump off a bridge. Sometimes yesterday happens and we just scratch our heads wondering what happened. I hope that today's conversation shed some light into it. But the point is 10.2% is a good return. Under the hood, 39% of that return, so almost 40% of the S&P 500's return comes from dividends and distributions reinvested. So when we think of our strategy, we try to keep it really simple. Good, high quality companies. And I know quality is a subjective term, but we want companies that are making great profits. We want them to have great dividends. We want them to be increasing those dividends. And when we put all those pieces together, we can have excellent returns, market-like returns. We're not trying to beat to the upside, but with far less volatility. Like, let's not have the big losses, because if we can eliminate that, then we can have, fairly peaceful, we can put our head on the pillow and sleep pretty peacefully at night when we see and we experience volatility, because we know that the investment thesis holds true, and that as long as our companies are continuing to make more money, we'll be in good shape. And when they don't, we get them out of the portfolio. We trim them. We try to manage risk by making sure that they're delivering to the extent that we want. I feel like I keep looking at the camera, forgetting you're down here. But the messaging is, great job by the Fed so far. Every single person, every economist complained that they were too late to start hiking rates. Now, as we saw yesterday, they're all complaining that they waited too long to cut rates. Maybe they did. Time will tell. But I believe that the job that they've done so far offers them the benefit of the doubt. And I think the data supports that, at least for the time being. Thus concludes my prepared remarks. And I hope that there's Q&A, and I hope that you will have some questions for me.
Thank you, Kevin. We do have several questions. Matt, you want to start us out?
Yeah, a few questions have rolled in, and for everyone on the call, please feel free to type a question in, and we'll get that answered by Kevin as well. Kevin, the first question in here, talk to us on, you did a great job describing your strategy. Maybe spend a little time talking about the additional income that's being produced year over year on top of that 2 to 3% dividend income.
One of the unique parts of the strategy that we implement, again, not thinking about it from income necessarily, but thinking about it from risk management, is that we utilize a very conservative covered call strategy. The covered calls are used as a means of trying to harvest volatility and smooth out the ride a little bit. I don't want to oversell it. It's a modest hedge, but what's wrong with any hedge? And I think when we needed it in periods of great volatility, it's served us very, very well. But even to the extent that we're using it as a hedge and not a primary cash flow driver, we're still generating historically 2, 3, could be as much as 4%, but I kind of think of it in the 2 to 3% range in option premium. So if we take the 2 to 3% dividends that we talked about, and we add an additional 2 to 3% in option premiums, which is a fairly low bar, now we're talking about 4, 5, 6% cash flow each and every year just walking in the door. And historically, that's averaged around 5%. Behind the curtain in our office at Capital Wealth Planning, we'd like to see it 4.5 to 5.5%. If it's 6, you can think of 2020, 2008, 2009, and yesterday, something bad's happening and volatility is really high. So the higher number isn't always the better number, but it does allow us to hedge the portfolio. So when you see like when you see an 08 or an 09 or the first half of 2020 or 2022, we don't have to go back that far. The stock market was down 20, 30, 40%. Take your pick of the indices. The covered calls allowed us to hedge the portfolio in such a way that we were down 1.5%. And we're not selling on performance. That's not, history is means nothing as we move forward. But I think specifically to your question, the covered calls are a wonderful addition to just investing in great blue chip dividend paying companies.
Good answer. Thank you. Talk to us on maybe with the current environment we find ourselves in, and maybe this is a two-part question, or I'm combining two questions here. Do dividend stocks make sense in this environment? And then fast forward a few months to the election, will there be any changes to your strategy based on election results?
Well, I'll answer the second part first, because it's important not only for you, but also for your clients that are in our strategy. We don't change our process or our methodology no matter what happens. So politics aside, it doesn't really matter who's sitting in the White House. It has very little to do with how many tubes of toothpaste Procter & Gamble sells. Now, that's an oversimplification on purpose, and I know that there's absolutely impact on the economy based on what party controls Washington, D.C. So there's always the idea that you think, well, Republicans typically better for the stock market. In this case, it's probably true because what we've seen, because we've seen each of these administrations for 4 years, so we kind of know what we're getting. I, as a capitalist, I believe in lower corporate taxes so that they can hire more employees and the economy can thrive on the backs of the American worker. The way we're looking at Democrats is there's been a lot more in terms of entitlements. Both are bad for the deficit. So neither party has this great plan to lower the deficit, but from a spending standpoint, there's two ways to do it. It doesn't matter. We're not going to change anything. I think I also subtly gave you some insight into what I would prefer to see happen, but it doesn't make any difference to the strategy. The opportunity set for dividend paying stocks in a lowering interest rate environment is a no-brainer because they become a much better alternative, because for the past year and a half, you could sit in a money market and it felt so good. It was like warm and comfortable, 5.5%. I don't have to take any risk. This is great, especially if you think of the previous 12 years where it was 0. Now, I know the 5.5% doesn't factor in the 3% inflation, but even if you do, 2%, 2.5% is still way, way better than 0. The only problem is the money market is like, if you've read the book, Who Moved My Cheese, like the money market's the first piece of cheese to move. So if and when we're having a conversation next year about money market rates, my expectation would be they're going to be a whole lot lower than they are now. And it won't feel as great because you're like, well, the inflation's at 2% and the money market rate's at 3%. So my real return's only 1%. So then it becomes a question of, well, if we have money in the money market, what do we do with it and when do we do it? Because Murphy's Law, if you put it in the market on Friday, yesterday happened. Of course it did. So I think what you begin to think about is dividend growing companies and dividend paying companies and really the stock market in general in a low rate environment because people will pay up for growth. But if there's an equity income component, which is the world that we live in, we feel like it being someone that can dollar cost average, because we do expect more volatility as we head into the election. Certainly if 2016 and 2020 were any precursor for that, it could be a lot of headlines. I would try to turn off the noise, read a book, take a walk. You already know who you're going to vote for. Why stress out over it? But vote, whatever happens, happens. And whatever party's in there for 4 years, doesn't matter all that much to the stock market. It matters politically, emotionally, like don't fight with your family members or your neighbors over it. If we're having a stock market conversation. Then you have 2025 and into 2026 where they're continuing to lower rates. If we don't have any flare up on inflation and the soft landing works, which I don't think it ever has before, but so far it is, then you start worrying about a recession in 2026. But that gives us a little bit of a runway.
Okay, great answer. Thank you. Another question, Matt and Randy talk about winning by not losing as it pertains to the stock portion of our portfolio. Would you say that your stock strategy falls in line with their stated goals?
I think that's why your dad and I became very close, fast friends 10 years ago, because we share that. And it's nothing original from you guys or from me. I have just a strong, strong passion for the idea of winning by not losing. And that comes from Warren Buffett. I mean, that's not a lesson too far from the Berkshire like playbook, but it's so powerful. Because if you think of 2022, and I use this example because I was at Thanksgiving dinner last year and my dad was like, why don't you own NVIDIA? Now he lives in the Poconos and the mountains of Pennsylvania. I don't even think he has a computer, but he knew what NVIDIA was. And I said, well, NVIDIA is not the kind, it's great that growth, I mean, you should own it somewhere for sure. You definitely need to have growth in your portfolio. But for me, I only buy companies that have dividends. And someday if NVIDIA pays like a dividend that isn't a rounding error, we'll absolutely take a look at it. But the Russell 1000 growth, which was up 42% last year. So now we're using an index instead of just one stock, heavily fueled by that stock. But you look at it and say, well, it was up 42% last year. I was up 8%. And I said, yeah, you're right. It was a year in which just a handful of AI companies brought the whole market up. But how they do in 2022? And of course, he didn't know, but I said, because the Russell 1000 growth was down 36% last year. So when you combine the 2 years, I blew it out of the water without ever losing an ounce of sleep. And you don't want to have every single penny in my strategy. I mean, that would be hubris, but it's just it's a mindset and it's a way of thinking about investing and removing volatility. So if winning by not losing is the mantra that we talk about, it resonates in any type of environment because it's just so much more powerful to protect what you have. And I would imagine the clients that we serve together aren't really like interested in having to go back to work, getting jobs at McDonald's and trying to cash a paycheck, especially when you've spent all this time working so hard to save. What you do for your clients is the best thing that you can do, which is protecting and thinking about risk-adjusted total returns. Because they care about total returns. Like my dad only cares about total return. We, the three of us, care about risk-adjusted returns, and that's what's most important.
Good answer. Another question, what type of markets do a covered call stock strategy work best in?
Well, they work best when we need them to most, in periods of high volatility. And I would prefer them to not have to work best, but just have to do okay. Because if we think of Q4 of 08 or Q1 of 09 or that first half of 2022 or 2020 and 2022, they work great, but the stock market was down a lot. And it's a lot more fun to just have an easier time. So a range-bound market, which I think we're heading into, a market that's kind of bouncing around, would be really ideal for us to collect dividends, clip coupons, bring in option premiums, get paid while we wait. And if it's a slow grind to the upside, we'll have some total return there as well. So I think that's more the market we're heading into. It could be really choppy over the next 2 weeks if that trade isn't finished with respect to the Japanese yen. If that yen carry trade's not done, if there's others, we'll see more air pockets. But we'll lean into them and be buyers because we know it's not an economic problem. It's an isolated event with a hedge fund.
Last question here. Kevin mentioned 2 stocks he bought yesterday. Does he think it's a good time to buy, whether it's your strategy or the overall market?
Well, I think it was yesterday for sure. We got a lot of it back today. Sometimes there's a head fake after a 5% drop. It doesn't always just get a V-shaped recovery. We seem to be used to it more recently. But I think it's always a good time to invest in high quality companies in a dollar cost averaging way. Would I back up the truck today? No. We have 10% cash in the portfolio, even after buying American Express and Apple yesterday. We play the slow game, the long, slow game. It's like the tortoise and the hare fable. We want to bore you to death, but get you to the same place. It's hard to time the market.
We would agree. Randy, any closing remarks or any other questions from you?
Kevin, we want to just say thank you again, personally as well as professionally. Before you got here, I was telling people it's so refreshing to meet someone in this business who truly, number one, cares about clients, and then number two, after success, has the humility that all of us would like to see in a successful person. So I congratulate you again, personally as well as professionally. I see your book behind you there. I have read your book, and for those hardcore people that want to know everything there is about options, very well done as well. But
It's
anyway,
good, but not great.
we do appreciate the partnership. Thank you.
Yeah, listen, I love you guys so much. You took a leap of faith with me when I was not as but I didn't have quite the same track record that I do now. So I'm grateful for that, and there's nothing I won't do for you. I hope that presentation was okay, because if you could imagine the sheer terror that I was going through, knowing that Matt's on the phone with Keisha, I'm trying to get our IT people on the phone, and nothing was working. So taking a deep breath, thinking through this problem, and coming up with a solution is very analogous to what we do in the investment world. So if this is any indication of how we operate under pressure, you can have a little more confidence today than maybe you did yesterday.
Well, we appreciate it. Keep up the good work, and glad you guys were spared the hurricane, it looks like, in Florida, right?
Yeah, a lot of rain, but we didn't need another hurricane. So thank you for your thoughts there as well. If any questions pop up from your clients afterwards, I'm always here. I'm a phone call away.
Kevin, thank you again. Have a great rest of the afternoon.
Thanks, you too.
Thank you,
Folks, Kevin Simpson with Capital Wealth Planning. Again, one of our favorite ways to produce income for retirement. Further questions, reach out to Matt and myself either by email or by phone. We sit down with folks on a regular basis, go through where they are, where they're going, and we think everybody does need a wealth coach. Thank you again, and hope to see you the next time on one of the Price Group webinars. Thanks again.